Hello and what is going on, lovely people of the internet? It is Hoop Money here with another video for you guys today. Today we are going to be going over ChargePoint, ticker symbol CHPT. Guys, this stock is going to be doing very well over the next few years, and I like this stock as a growth stock. I'm just going to say it outright right now. I do like this stock because it is very disruptive. It's a play on the entire EV market, which is inevitably going to be growing in the coming years, especially by 2030. There's supposed to be around 30% of all cars being EV, and by 2040 it'll be even more than that. So guys, ChargePoint is definitely going to be a long-term hold, as it is a dominant force in this market. Now, before getting to this video, I want to bring to you guys this opportunity in investing. So if you use the link below, you can sign up for Public, where you don't even have to deposit any money. You just sign up, link your bank account, and you get up to $50 in free stock. So I usually don't do these type of things at the beginning of the video, but this just seems like too good of an opportunity to pass up. You don't even have to deposit any money. You just have to sign up for the account. Public is also a very good platform. It's kind of similar to Robinhood in terms of its user interface, but it's going for more of a social media stock investing platform. So you can see what other people are talking about on the platform. You can get informed. You can become a much more informed investor by using this platform than on Robinhood. The other huge thing about this platform is that your data is not compromised. So your trading data is not being sent to huge hedge funds, and there's no payment for order flow whatsoever. These guys rely solely off of tips on their platform, and I'd imagine since they're going to be some social media stock brokerage, they're going to bring on some advertising. But I do really like this brokerage just because it has a great user interface and it's easy to use. It literally reminds me of Robinhood when I'm using it, and they're not trying to compromise your data, so that's why I like it. That's why I wanted to bring it to your attention. Anyways, enough with that. We're going to get right into the video. If you guys have not already, remember to subscribe to the channel and turn on post notifications, as we make these types of analysis almost every day. It's kind of difficult to be putting these analysis out every day, as it does take a lot of research to do and then a lot of editing to do. So yeah, make sure you subscribe to the channel if you want to see more of that. And the number one thing you can do for me is to like the video, because liking this video helps spread this video around YouTube. It helps me get noticed as a creator. And if you genuinely enjoyed my content or learned something, that's all I ask. Just like the video. So without further ado, let's get right into this ChargePoint analysis. So ChargePoint is an electric vehicle charging company that is focused on offering the best electric vehicle charging experience for everyone involved in the shift to electric mobility. They've been around since 2007 and have become the largest EV charging company with more than 7 times more charging stations than the runner-up, giving them a 70% market share for electric vehicle charging. They're currently operating over 132,000 different EV charging stations. They charge passenger cars, delivery vehicles, buses, and any type of EV, you name it. They've built a fully integrated portfolio of hardware, cloud services, and support with the best technology in the industry. ChargePoint is integrated in-vehicle through native systems and in Apple CarPlay and Android Auto. ChargePoint is also integrated through payment systems and mobile wallets. At home, ChargePoint is integrated with in-home systems like Amazon Alexa. 361 million kilograms of greenhouse gas emissions have been saved by using this company, making it a very energy efficient company and one of the leading companies in the green revolution. Over 88 million charges have been done to date, and many more to come. With over 13 years in business and 70% of the EV charging market, ChargePoint is clearly the dominant force in the EV charging market. And with all this success, currently someone is plugging into a ChargePoint charger every 2 seconds on average. Now, I always mention on my channel how important it is to pick the winner in these growth stock categories. Whether it's weed, whether it's electric vehicles, whether it's gambling, you want to own the winner in these categories. So let me tell you, ChargePoint, with over 70% market share, is clearly the winner in EV charging. That being said, I believe that ChargePoint is the safest bet if you want to invest in EV charging. Investing in ChargePoint is simply investing in the broader growth of the EV market just because of how ChargePoint gets their revenue. However, the EV market is is currently growing faster than ever. EVs are currently projected to be 9.9% of all new vehicles sold by 2025 and 29.2% of all new vehicles sold by 2030 in the United States and Europe. Now, comparing that to numbers in 2019, it was only 2% of all new vehicles sold. And the jet fuel to the EV market growing even more is government investing, and that's also why the stock price jumped so much this trading day. Cumulative investment in EV charging by 2030 is said to be around $60 billion and then close to $192 billion by 2040. So governments will be investing heavily in the switch to electric vehicles. And like we briefly touched on already, but we're going to go into more detail on it now, President Biden's $2 trillion infrastructure bill, he says to have 500,000 EV chargers nationwide by 2030. And this was recent news, and this is exactly why ChargePoint stock has gone up significantly over the past day, because ChargePoint will definitely see some huge government investing, which means as a shareholder you don't need to worry as much about dilution or them issuing debt that they can't afford, because the government will definitely be giving them some grants. And the reason that this investment will most likely be going towards ChargePoint and not individual car companies is because individual car companies are focused on creating their own electric vehicles. They're not really interested right now in creating infrastructure for the electric vehicles, so ChargePoint, as the leader in this category, will most likely be seeing the most government investment. This will give ChargePoint a huge edge over their competition as long as they can remain a cheap and trustworthy target. ChargePoint currently has two different revenue streams. They sell individual chargers and they have a subscription model for their chargers. Now, selling charging stations is pretty simple. It's exactly what you guys are thinking. They simply sell their charging stations to businesses themselves. With the subscription model, which is coined ChargePoint as a service, the company offers subscriptions lasting 1, 3, or 5 years for their ChargePoint service, and this becomes a recurring revenue stream for the company. Now, ChargePoint as a service is great for businesses because it will save them on initial capital expenditure, but at the same time, it will offer ChargePoint a recurring revenue stream for the long term, which is awesome. However, that being said, the most popular option for ChargePoint systems are the one-time purchase. What's really cool about ChargePoint's revenue structure is that they do not depend on what people fill up their cars for. So let's just say a customer pays $10 to charge their car at a ChargePoint charger. This does not affect ChargePoint's revenue. What affects their revenue is how many systems they install. So this is why it's a play on the broader EV market, because as the EV market grows, there's going to be more demand for chargers, and then in result, more revenue for ChargePoint. Since ChargePoint's customers own these EV charging stations, ChargePoint can focus their capital on research and development so their technology can evolve over the years rather than maintaining these systems that are in place nationwide. Now, this point is actually huge because it would cost them a lot of money to maintain these systems nationwide, and in result, them saving money and putting it towards research and development is the perfect thing they can do, because in the EV market, technology is always evolving. So in order to keep up in this rapidly growing market, they have to actually spend this money on research and development. ChargePoint is a growing company with a history of losses, which makes it inherently risky, but we're going to talk about why this is not as risky as it sounds. Their losses aren't too extreme and they are well covered. When you look at their revenue and then the cost of revenue, they actually end up pulling a gross profit from what they sell to their customers. So when they report a net loss for earnings, that is because of research and development, marketing, and administrative expenses. Their SPAC acquisition also increased the cash on their balance sheet, which is really good for a growing company. It's always good for them to have extra cash. And there will be plenty of investment to come, as this is the leader in EV charging, whether it's from the government, whether it's a PIPE investment, which is private investment in public equity, whether they raise money through offering additional shares. Guys, these guys can raise money however they want, and their research and development costs will definitely be well covered in the future. ChargePoint will also be facing a variety of competition from other companies in the EV charging industry. If another company turns out to be cheaper than ChargePoint, the government can definitely turn to them, as the government is always looking to save as much money as possible with their investments. ChargePoint is currently not the dominant market leader in Europe. They do not own 70% of the market share in Europe. There are other companies that have much more EV charging than ChargePoint in Europe. So this is definitely a risk, as they are going to have to start from square one when penetrating the European market. Tesla is also building out their supercharging network all across the United States, and Tesla is definitely a company that can compete with ChargePoint. Now, that being said, Tesla and other EVs do not have the same charger. However, there are adapters you can purchase to use each other's charging system. So this could definitely be a risk going forward, as Tesla will definitely have the infrastructure to do this. Going forward, ChargePoint may have to raise additional funds in order to keep operating their business. Now, this may be through equity issuance, debt issuance, or through government investment. Now, government credits would be a great thing, and they are very likely to come. As we've talked about, the infrastructure bills includes EV charging, which is great. Issuing additional equity will definitely cause some strain on the shareholders. We talk about this in almost every video when we talk about a growing company, because it lowers your expected return as an equity holder. It is also historically not a great sign that a company has to issue new equity in order to survive as a company, because that means they do not have a good cash supply. Raising debt would actually not be too bad of an option for this company, and this would be because when you raise additional capital through debt, you actually can invest that capital back into the company. It raises the return on investment for the company, so you actually make more money from that debt. And as long as that extra money that you make is more than an interest payment, debt is a good thing to have. It's a common misconception if debt is bad. It's only if you have so much debt that your interest payment is so high and you can't afford it, which we've talked about before as well. But in general, debt is not always a bad thing when investing. ChargePoint relies on mass adoption of EVs in order for their company to be successful. If car manufacturers decide that they do not want to produce EVs anymore, or the move to EVs is much slower than anticipated, ChargePoint will definitely suffer as a company. A lot of numbers are being thrown at us for the expected adoption by 2030, by 2040, etc. for EVs. So if we do not meet these numbers in these timelines, yes, ChargePoint will definitely suffer. There also may be a hidden bottleneck in this EV system that we just do not even know about yet, so that can also definitely affect this company. There are also other alternative energy options that are competing with EVs. This includes highly fuel efficient gas powered vehicles, hydrogen powered vehicles, biodiesel and ethanol powered vehicles. These are all competing with EV to take over the clean energy vehicle space. As a technology company, ChargePoint is also required to constantly innovate so their products are the best in class. An example of this would be if a new fast charging technology came out and they could charge electric vehicles in half the time as a ChargePoint charger. Yes, ChargePoint would have to innovate and compete with this technology, which could be very, very costly. We are going to take a look at their balance sheet and their income statement. As you can see, this is for ChargePoint. This is their most recent consolidated statements. And as you can see, their cash and cash equivalents have went up by a lot, which means this company is good for cash, as well as their assets have gone up a lot in the past year. So that is really good, especially for a growing company. We like to see them in a very good cash position. This value right here, the 29,988, this is pretty cool because that is not too high of a value for property and equipment. And like I said earlier in the video, they do not own these charging stations. So they will not have too much property, plant, and equipment besides for basically the office space that they are leasing and owning. So essentially most of their assets are cash that they can use to further invest in their business. Now their biggest liability, and this is mostly due to their special purpose acquisition, is the redeemable convertible preferred stock and warrant liability. So essentially they raised a bunch of capital. There's a bunch of outstanding warrants that could be exercised for this stock, so of course that liability is going to go up. That was to be expected, and this is most likely priced into the stock already. Another really good thing is, as you can see, their current assets at 226 million and their current liabilities at 118 million. So current assets are basically the assets that they can have liquid within a year, and then debt is the liabilities that are due within a year. So if the current assets outweigh the current liabilities, it shows that the company is in a strong financial position. In this case, their current assets outweigh their current liabilities by almost double. So we can see that ChargePoint is in a very good financial position right now. And as you can see, they have paid off some of their long-term debt. It was at 34 million in the year before. Now it's at 24 million. So it's good that that debt's coming down. Although if they do decide to issue equity instead of issuing more long-term debt, I may be a bit concerned. However, I don't know if that's going to happen. They have lots of money flowing into this company through investments. So I think we're good to go. Alright, and now we are looking at their consolidated statements of operations. Guys, I'm not really sure why they name it this. It's basically an income statement. What I really do like is that from 2020 to 2021, their subscriptions revenue went from 28 million to 40 million. So what's really interesting is about their revenue is that their network charging system, so this is basically the sales of their charging systems, went down around $8 million, but their subscriptions went up by $12 million in 2021. So I think that's really cool. You can also see that there's much higher margins on the subscription model. So the fact that this is growing is really good. They got 40 million in revenue from the subscription model, while the cost of revenue was 20 million. And then we'll take a look at their network charging systems. That's $91 million in revenue and $87 million in cost of revenue. So they're only making $4 million on $91 million of sales, while they're making $20 million on $40 million of sales for subscriptions. Guys, they need to keep pushing this subscription model. It is a very profitable way for their company to grow, and going forward, if this number increases, this stock is definitely going to be a huge buying opportunity. And as you can see, their total revenue increased only about 2 million in 2021. However, their gross profit has increased by almost double, not quite double, but almost double, and this is mostly due to their subscription revenue model. Now this is what I'm talking about. The reason they're posting a loss from operations is because of the research and development, sales and marketing, general and administrative. They're posting total operating expenses of $153 million a year. Guys, this is a lot, but they do have the cash to cover this, like I said, and they will be seeing plenty of investment in the future, so I do not think this is too bad of a number. Now, as you can see on their FinViz chart, they are basically in the middle of this channel that they're trading in. You can see those blue and pink lines. So if we do continue to see this recovery in the bull market, then we can definitely expect the stock to go back up to $33 in the short term. So it is still definitely a buying opportunity. However, if we look at the trading view chart right here, it is definitely being overbought right now, and it actually is bouncing down off, as you can see in this candle right here in the last hour, it's bouncing off this 200-hour moving average. So we're likely to see a little correction before the continuation of this stock. You can also see right here the RSIs on the overbought side for this stock, and that makes sense. The stock has gone up a lot, so there will most likely be a tiny correction before the stock continues to climb. I don't think it's anything serious, but it would be very bullish if the stock gets above this pink line. You see the 200-hour moving average, and if it uses this as support, we can see a reversal in the stock, and we can see it keep climbing and climbing and climbing. Now we're going to take a look at some of these numbers right here. As you can see, the price to sales ratio is around 50, so that is relatively high. However, we have seen worse. Definitely means that we're trading at a premium. However, this stock definitely seems like a pretty safe bet for a growth stock, so I'm just going to go ahead and say that I think this price may be justified, given that it'll probably continue to see growth in the future, and I think most people are pretty confident in that. We can also see it's up 164% on the year, which is another indication that you're paying a premium on this stock. So that is also something I like to show people, because it can also show that you are not getting the best value for this stock going forward. I got in this stock around $14 a share, and as you can see, even after this huge correction, after it got all the way up to $48 a share, it only got down to about $20 a share, and this is just within a few trading months. So you never know what's going to happen with the market. It is in a downtrend overall, so we just need to see what's going to keep happening with the market, and then we can make a decision on whether or not it's a good price point. I think $20 would have been a great place to get back into this stock. However, we just don't know where it's going to go. We don't know what the market's going to do, and as a long-term investor, we try to stay away from this short-term prediction. However, it is hard to say how much of the future is being priced in with some numbers like 50 price to sales and 164% year-over-year growth. Another funny number right here is the price to cash ratio, which, guys, this is just not true. We went over the cash. They have plenty of cash. On FinViz, for some reason, they say that this company has zero cash. It's something to do with the SPAC, and I don't know, but they say that they have 73,000 price to cash ratio, which is just not true. So just ignore that number. All in all, I think ChargePoint is a very good company. They're in a good financial position for a growing company, as we went over when we looked at their balance sheet and income statement. And you may be paying a bit of a premium for the stock price itself, as we talked about its valuation a bit. However, this company is going to be seeing lots of investment and lots of growth in the future, because we know the EV market is going to continue to grow, and their growth is directly correlated to the continuation of this EV market growth. As long as they keep up this subscription model, guys, I really like this subscription model. We showed you guys the cost of that subscription model compared to the revenue that they pull from it. That'll be the best thing that we can see in future statements. If they continue the subscription model growth, oh my gosh, this stock will be great. This stock will see such great returns. And yes, there may be short-term volatility, and that's just due to the premium you're paying on this price and just a lot of different factors such as speculation as well. So just be careful with that part, but it is a good company, and I do think that if you hold this thing for the long term, you will definitely see some good returns. So I'll give it my thumbs up here, and yeah, I think it's a good stock. That's all I got. If you guys have not already signed up for Public, I'm going to leave a link in the description below. Guys, I really do like Public. Like I said in the beginning of the video, it looks almost exactly like Robinhood. It's very easy to use. It's becoming a social media platform for stocks. We've seen over the past year social media's involvement in stocks, like Reddit, like Twitter, and like StockTwits. There's all these different platforms, but imagine putting it on the exchange itself. That's exactly what Public's doing, and they have a very good user interface. It reminded me of Robinhood's easy to use interface, so that's why I like it. And if you sign up with the link below, you don't even have to deposit any money, and you get up to $50 in free stock. So you might as well do it. It's literally free money, so why wouldn't you do it? At that point, I don't know, you're throwing away money by not doing it. And the biggest thing that this company is doing is that they are not selling your trading data to hedge funds. So that's why people hate Robinhood, because they're selling your trading data to hedge funds so they can directly profit off of the retail consumer. So we want to get away from that. Yes, I still have my Robinhood, but I'm going to be looking to transferring my funds to Public, and I do not want to see payment for order flow at all. Like, that's not good. That's not good for the retail trader at all. That's just going to make someone who already has billions of dollars more rich at your expense. So you might as well get to a platform that refuses to do that. Enough of all that. I hope you guys learned something. I hope you guys enjoyed the video. If you did, remember to leave a like on the video. That's the most important thing you can do for me. If you want to keep seeing videos like this, make sure you subscribe to the channel. Leave a comment on another stock that you'd like me to review. And yeah, that's gonna be it. Peace.